Welcome everyone to Tax Power Hour. My name is Hector Garcia and I'm your host. This is the monthly webinar for February 2017. Today is February 1st, 12 p.m. Eastern. Tax Power Hour is a small business and self-employed tax tips and tricks monthly webinar. And today's episode is commonly misunderstood tax deductions. And this really comes from my experience, and we're going to have a guest speaker here as well, experience on what are the things that most of our clients, we're tax practitioners, get confused about, or there's misunderstandings about, and in some cases, urban myths about on specific tax deductions. So in this episode, it's going to be focused on meals and entertainment, travel meals, and meals for employees. And then we'll kind of do some contrast between personal vehicle, mileage deductions, and the home office deduction. So that's going to be the topic. So we're going to spend about 5 minutes or so just kind of doing the introduction and talking about what other events we are involved with. And then we're going to spend the most amount of time on meals and entertainment and travel meals. And that will be about 15 minutes. And then we'll do the distinction between personal vehicle, mileage deduction, and some of the tips and tricks around what are the best ways to keep records of that or how to record them for tax deductibility. That will be about 10 minutes. And then we'll go and discuss home office deductions. And there's some really important pieces around home office deductions. That will be about 10 minutes. And then we'll leave it open for Q&A. As a matter of fact, you can ask questions throughout the entire webinar. And then we'll be monitoring those questions. Me and Peter, the guest speaker, will be monitoring it, and we'll try to answer them as we go. But we will actually ask some of those questions verbally on the Q&A section. Okay, that way we are actually answering those verbally as well. And it's the middle of tax season, and there are sometimes misspellings, especially on words that were used so far. So I apologize. That's mileage. It was misspelled. Anyway, what is Tax Power Hour? We are a small business and self-employed tax tips and tricks webinar. It's a monthly webinar series. If you're attending it live, you don't need to do anything else. If you're watching this recording in YouTube or anywhere else, you have to register to be able to attend it. You register once, you'll be able to access it every single month. For the time being, it's free. We don't know if this is ever going to be a paid service, but for the time being, it's free. We're trying to figure out, how much people want to learn about tax. We have a website that's under construction, taxpowerhour.com. So be sure to visit that in the next couple of weeks as we add the video recording and some of the notes from today's episode. And there's also the Facebook group. We just created that, brand new, created the Facebook group to continue the discussion. And if you want to ask me or any of my guests the tax questions, the best place to go is to the Facebook group, especially if it's a sort of a generic tax question. Do it to the Facebook group. If it's a very specific tax question having to do with your specific tax circumstance, email me or email the other person, and we'll figure out whether we can give actual advice via email, or we would have to set up an actual appointment. Anyway, this webinar series is every first Wednesday of every month. It's going to be between 30 and 60 minutes. We're not going to commit to a specific time frame just because some topics are longer than others. So today's going to be about 45 minutes. As I mentioned before, register once, access all episodes. We may have special episodes that are created with sponsored content. Of course, if we're going to keep this free, maybe if software manufacturer or anyone that serves the tax or small business industry, we will obviously welcome those sponsors in, and we may create those just to keep the webinar alive in the case that we want to keep this webinar free forever. This is not meant for accounting professionals, for CPAs or enrolled agents. We are not trying to educate the people that in some cases know a lot more than me and some of our guests. We're trying to just really educate or help facilitate a discussion to the non-tax experts, so we can have more of a layman's type of conversation about, hey, what's going on with the tax law and what are some of the practical examples around applying it. We're going to discuss changes to tax law. So this year, as President Trump and the Republican Congress make changes to the tax law, which they promised they did, we're thinking that there may be some changes. Some may be good, some may be bad, depending on where you're sitting. So we'll definitely watch out for those. And as soon as we have a clear set of law changes and proposals, we'll actually dedicate an episode to that. So that should be fun when that comes out. We'll talk about some practical examples, and we may discuss, tax software or apps that facilitate tax planning of some sort. We may discuss payroll tax issues, sales tax issues, taxation of different entities, and just any taxation topic. And we want to try to make this as fun as possible because I know and I understand that if you're not a tax professional, tax is typically not a fun thing. Now, as I mentioned, my name is Hector Garcia. I'm a CPA. I practice in South Florida. I'm the CEO of Garcia CPA, which is a accounting consulting, tax planning, and management consulting firm here out of Miami. I'm also a certified QuickBooks Pro advisor and a QuickBooks reseller. And my email is hector@garciacpa.com. Best email to reach me to. Now, I invited my good friend Peter, who is from California. He's a tax preparer and an accounting technology consultant, just like I am. He's my brother from another mother on the West Coast, and he's the CEO of Core Performance Consulting, based out of Los Angeles. Not exactly Los Angeles, but I'll let him specify exactly where he's from. And he's a certified pro advisor and a Microsoft certified partner. And there's his email, peterc@coreperformance.net. Peter, are you on? Do you want to say hi?
Good morning, everyone. My name is Peter Cullen. I'm happy to call in on this Tax Power Hour. I really think that these Tax Power Hours can be very helpful for all of us as we share knowledge, share information, and share ideas really about how to build and grow our successful tax practices.
Sure. Thank you, Peter. Yeah, so we do have some people that are in the tax business, so that would be great. We would definitely share some of our own experiences with running our businesses, and then we may have some people watching that are not tax professionals, and we would like to speak to you as well about tax. Now, we have to make a disclaimer because in the world of tax, you got to disclaim everything. So first of all, because of Circular 230, we're not allowed to give written or electronic advice that is based on unreasonable legal or non-factual assumptions or representations. Because we're not giving anyone specific advice, we have to make it explicit that this is not tax advice. This is a tax discussion, and you should consult your accounting professional, discuss the facts and circumstances, or hire one of us, myself or whoever it's a guest at the time, to help you with your specific case, just because we cannot just give advice into the ether like this and somehow it be taken into evidence. So again, this is not meant to be tax advice. This is meant to be purely hypothetical based on cases that we're putting together. But for your particular case, you consult your own tax professional to discuss your own facts and circumstances. All right, perfect. So let's start with travel and entertainment, sometimes called meals and entertainment, travel and entertainment. So we're going to break this down into 4 topics, and this is going to be the biggest of the topics. We're going to talk about meals in the context of entertainment, meals in the context of travel, meals in the context of buying food for your employees, which is often called for the convenience of employer. And then we're going to talk about the concept of business travel as a whole. So let's start with the big one, meals as the context of entertainment. First of all, golden rule, going to a restaurant and buying food for the most part is not tax deductible. Again, going to a restaurant, buying food is not tax deductible. It is not necessary to feed an employee or a business owner in order to function in a business. The IRS deemed it absolutely not. No business can pay for the meals of the owner of the employee and call it a tax deduction because feeding them is not a necessary and ordinary business expense. However, if you go to a restaurant with the context of entertainment, it has to be very specific, the context of entertainment, then it becomes deductible. However, it is not 100% deductible. It is 50% deductible because the IRS figures out that you have to eat anyway. So you're going to eat no matter what. And if you and somebody else, a client, a prospect, go to eat, we should cut that in half to at least only get the deductible portion, the portion that quote unquote you didn't enjoy it, because that's the problem. If you enjoy it, it's not deductible. That's kind of like the golden rule of the IRS. So again, it needs to be in the context of entertainment. Now, what does entertainment mean? Entertainment means that at least the business owner or an employee of the business, it's together with another human being. So it has to be with a client or an employee of a client in case that your client is in other business. So it has to be somebody that you conduct business with. So you have to have a business relationship. Now, technically, everyone that can refer you business is a business relationship, because that would be a prospect. So if you are going to use prospect, right, as the way of identifying that business relationship, you may have to, during an audit, also prove that not only that person, potentially sent you business, but start making some connections on some actually closed business that you had. So now, how do I substantiate it? Number one is you have to prove that there was a business discussion before, during, or after the meal or entertainment. Now, how do you prove it? All you have to do is keep a copy of the receipt, and in the back of the receipt, state a clear and specific business purpose. The IRS makes it very easy. So if I got a restaurant receipt and I spent, let's say, $80 on steak dinner with a prospect, I have to put down there, spoke to Raymond about potential clients that are opening a business from South America. He's going to refer them over. We're going to meet them next week. That's clear and specific. Your receipt cannot say meal with Raymond, talked about business. That won't work. So that's as easy as the IRS makes it, right? If there's a business discussion before, during, or after, which is substantiated simply by writing the business purpose clearly and specific on the receipt, that's good enough, right? Now, no receipt is needed for $75 or less. However, you still would have to prove that it is a business meal, right? So although you don't have to, show the IRS exactly what you ate, or the receipt, if the actual money coming out of the bank is less than $75, you will still have to have a business purpose. Now, another key element is the surroundings have to be conducive to a business discussion. In other words, there needs to be a place to sign a contract. That's kind of the golden rule. So, for example, if you go to a nightclub and the nightclub is totally dark and there's no context in which we can actually conduct business by potentially signing a contract before, during, or after, then entertaining a client in a nightclub may be a lot more difficult to substantiate. Now, the key element here is that the IRS doesn't specify, hey, nightclub, yes or no. Nightclub under 500 or 500, yes or no. The IRS doesn't specify any of these things, but they use this other elements, like business discussion, business relationship, place to sign a contract. These are all these other factors to be able to, then believe the taxpayer or accept their substantiation in case of an audit. Now, another key element, it needs to be arranged or planned in advance. So you can't just bump into someone and say, let me buy you dinner to talk about business. Now, I'm sure there are circumstances in which you can totally prove that you bumped into someone and you planned it for 5 minutes later, and that's technically planning for it. But the concept is that, it can't be spontaneous. It has to be purposeful. It has to be intentional, right? Because business is not very often accidental. Most of it is intentional. And the other key element is cannot be extravagant or lavish. So, and that they use that in quotes, and that's actually in the IRS instructions. So, I mean, yeah, if you have a really good client, let's call him a rich person, and we take him to a nice expensive dinner, that normally is okay. But if the dinner is ultra extravagant, let's say $1,000, and then the business we conduct with that person is, let's say, less than what we spend at the dinner, that would be very difficult to substantiate that wasn't extravagant or lavish. So the IRS does understand that if you're dealing with higher ticket items, if you're dealing with clients that buy a lot from you, that spend millions of dollars with you, that you can buy expensive dinners, quote unquote. But if it doesn't sync up like the amount of business you're doing with that person with the amount of expenditures you're making, then they may deem it extravagant or lavish. So that's my spiel on meals with the context of entertainment, and it also works if it's just entertainment. So if you want to take a client to a concert or to a baseball game, as long as all these other things fit, we are going to be totally okay. So could you sign a contract in a baseball game? Yeah, I would say it's difficult to do so, but it could definitely be done. In a concert, yeah, it's difficult to do so, but it could technically be done. A nightclub, it makes it a little bit more different. Peter, what's your take on that? What's your experience on meals and entertainment?
Well, I think that, yeah, sorry, I mean, you certainly have gotten into a lot of the detail. When I'm working with clients, what I generally ask them to do is when we look at their meals and entertainment expenses, and also with regards to business travel expenses, what I get them to do is I try to get them to get their QuickBooks file to be set up in such a way that there is some delineation of these different activities. So what I generally do is I have 4 or 5 expense accounts inside the GL. All right. So I have one for just basic business travel, which is when you are having to go somewhere for a business trip. So it could be air travel, it could be driving, it could be taking a train or a bus. All of those expenses go into the business travel, and as long as the trip is conducted within the context of doing business, those expenses are fully deductible. And then you get into meals and entertainment expenses, and that's where we have to separate out meals and entertainment expenses within the context of what you just shared, which is basically when you are entertaining someone or meeting someone within the context of doing business. It could be prospecting, or it could be someone that you're currently doing business with. Those go into a separate expense account called meals and entertainment, because those are 50% deductible on the tax return. I then have another account called company meals, which is when we're hosting people inside the company and when we're paying for their meal. That goes into another expense account called company meals. Those are fully deductible. And then finally, I have some other accounts. It could be if there are company vehicles used within the business. We have another account to track company mileage or expenses associated with company vehicles. So that's what I generally do with company owners, is I talk to them about why these accounts are needed and how they filter through onto the tax return, and why the relationship between the expense account inside the QuickBooks file and its correspondence or correlation to how the activity, how the operational side of it gets reported on the tax return, why it's important so that we have sustainability of the return deduction.
That's a good kind of practitioner's tip on all that. So real quick, Peter, it was sounding a little bit cut in and out. So if I don't know if you could try to call into your phone, maybe call into your phone and see if it sounds better. But yeah, I really appreciate that. Now I want to talk about meals while traveling, and this goes hand in hand with the stuff that he was talking about, right? So to separate and split out the difference between the different contexts of meals. So, for example, meals while traveling. This is whenever you're traveling, quote unquote, away from your tax home. So if you're traveling, quote unquote, away from your tax home, and you can tell it's the middle of tax season, and I'm putting these things together at 3 o'clock in the morning after I'm doing 1099. So I got some misspelling here. I apologize. Anyway, so the way you know that you're traveling is because you're away from your tax home. Now, the IRS is not very specific about what constitutes travel, quote unquote, away from the tax home. I use the rule of the 50 miles just because there's a 50-mile rule whenever you're moving, and to make moving expenses deductible, I interpret moving expenses, that 50-mile rule, to be pretty much the same sort of rule for travel. So if you're going 45 minutes away from your office, right, and it's less than 50 miles, and you're entertaining a client, to me, my interpretation is that is meals and entertainment, which is 50% deductible. But if I go to a conference and during that conference, I pay for my breakfast, lunch, and dinner. And again, it's not lavish or extravagant. Even if I'm not entertaining a client, it would still be 100% deductible because it would be like a reimbursable meal that I would pay an employee in the first place, whether or not I'm paying for myself, the business owner, or I'm paying for my employee. Now, again, the meals have to be while traveling on business purpose. And there are some cases, and we'll talk about business purpose in another slide, but there are some cases in which we mix business and pleasure, and we'll discuss that a little bit later on. However, how do you substantiate your my travel meals? So it would be the same way, right? You would need your receipt, but because you don't need to have a business discussion, you don't need to write down who you ate with, and you don't have to eat with someone. So in this case, you just have to have the receipt. And if the receipt shows you the physical location where the restaurant was, and then you have other proof that the reason why you went to that business location was because you were visiting a client or on a conference or visiting a subcontractor or a factory that you work with, whatever. As long as you can prove that you went to that location for business, as long as you have that receipt and you can prove that it's away from your tax home or within that what I interpret a 50-mile radius, then it would be 100% deductible. Now, you can use what's called actual expenses, which is you actually have the receipts and all that stuff. And you can have something what that they call the per diem rates. Now, the per diem rates don't require you to have actual expenditures. You can actually reimburse an employee or even the business owner a per diem rate on travel and not have to keep any receipts for any of their expenses as long as they're within the per diem rates. Now, let me show you what I mean by that, because that's just very difficult to understand non-contextually. Let me go into the website. So I'm going to go into this website here, which is the GSA website. And I'm actually pasting it as well in the chat. So all of you will have access to clicking on that link if you kind of want to follow along as I put that. But I'm going to go into this website, and this is called the GSA Per-Diem Rates website. And basically, in here, this would be the same type of reimbursement rates that any government employee or government contractor would get. And these are broken down by location. Again, if you don't want to have receipts and actual expenditures of your travel expenses, you can reimburse your employees or the business owner a per diem rate. So, for example, let's say it was for last year. So let's say last year, one of my employees went to New York City. So I'm going to go ahead and put New York in the state. I'll leave the city optional just so we can see. And then I'll put the zip code and then click on find rates. And that's going to take me to a table that shows me pretty much every city in New York and the month of the year. And based around the month and the city that you traveled, there's a dollar amount that we can use as our official per diem rate. So for example, we got New York City, and it tells you exactly which boroughs or county it includes. So I got New York City, and let's say, for example, around December, we went to New York City, and it's $306 a day. Now, what is that $306 represent? Well, that represents that every single day I can reimburse my employee for meals and hotel. Well, actually, the $300 a day is for the travel portion, not the meals, just the travel portion. I can reimburse $300 a day. And then if you look all the way to the right, you see that $75, $74, that is for what they call meals and incidentals. So you can combine the two. So you got 306 plus 74, that's 380. You can reimburse or deduct as a business $380 per day of business travel without having to have any receipts. So that's actually a really important thing, just because during travel, especially in New York City, people end up paying in cash, or they pay a cab in cash, or they pay a restaurant in cash, or like a food truck, a hot dog on the street, that sort of thing, where you really don't work with receipts that often. So knowing those per diem rates, it's also a good standard to set. If you have an employee traveling and they have actual expenditures and they go over those per diem rates, you could technically tell them, hey, you're abusing a little bit, the average rates here. So try to stay within that expenditure rate. So it could be useful for two things. One, to kind of gauge, whether you're, spending a lot more than the average, and two, so you don't have to have actual substantiation. Now, one interesting thing about the per diem deductibility for travel is the day that you travel to and the day that you travel from, you can take three-fourths of the per diem, right? Because it's assumed that you're not traveling the entire day. Now, you could argue that if the employee leaves their house at 4 o'clock in the morning and then they come back at almost midnight the next day, I think you could argue easily, simply, that hey, this person was spending the whole day there and they can't and they don't want to take three-fourths and they should deserve to be able to take the whole amount. I think that's very possible, but I mean, just the golden rule to use is the three-fourths. Peter, you came. You want to chime in? Do you have any specific suggestions or experiences with meals while traveling?
I think you covered it well. To me, the way that I look at these things is, I try to make sure that there's just clear, basic, simple rules that we're following. I try to keep it very, very simple because the tax code, as we all know, can get a little bit arcane. It can get a little bit vague in some instances. So, I follow that keep it simple, stupid rules with regards to tracking expenses and making sure that we're able to draw a clear line between the QuickBooks file and the tax return.
Right. And I got a couple of questions here. I'm gonna just kind of say them verbally. So one of them, it's saying, this is from the last section. What is saying? Hey, if I take my client to the Super Bowl, would that be considered extravagant or lavish? And look,
let me actually take that one on, please.
Yeah, go ahead.
So this is a really good question, and of course, like if you're thinking about doing entertainment or doing any sort of activity to promote yourself, of course, if you can make the case, meaning if you can substantiate that within the overall context of the relationship that you're trying to form with this potential customer or with this potential business partner, that this activity that you want to invite them to and for them to join with you on, even if it's going to the Super Bowl, if you're able to make the argument that the potential upside, if you will, meaning the overall business relationship that you can formulate as part of this ensuing relationship, then of course it's deductible under the law. But you have to be able to make that case.
So one of the things.
So if I could, if maybe.
Yeah, I say, Peter. One of the things that is important about taxes is that normally we are worried about this at the audit level, right? Because we don't have to make a case while we prepare the return. I mean, you should technically have the case pre-built, but technically speaking, what you're saying about making the case, you're talking about that discussion we have with the auditor or with the tax judge, right? But
no, actually, no. I'm saying within the overall context of the way you think about these things. In terms of, this is ahead of time. If I'm gonna take Hector to the Super Bowl, there better be a pretty substantial reason for me to spend that kind of money, and what the ultimate business goal is, and what the context of that is. You can make it to yourself, you can make it to Hector, you can make it on this tax power hour, or you could make it to an IRS auditor. You have to be able to make that case. That's what I'm trying to say.
No, right. But the point I wanted to make, Peter, is that all audits are in retrospect. So all audits are going back 2, 3, 4 years, right? So, so you always have 20/20 vision, hindsight, both to your benefit and to your detriment. So if you took somebody to the Super Bowl 3 years ago, and they gave you no business, no lead, then you can make it very difficult to make a case that was actually a productive entertainment process. Now, if you did it once and every other deals you close, it's not a big problem. But let's say, for example, you take your best friend to the Super Bowl 3 years in a row, and there's still no business.
That's different.
Right. You can't connect. You can't make a connection. Hey, we did some business
Yes.
with these people. So remember, all
Yes.
audits are 2020 vision hindsight. So you can never use hypotheticals. What if next year? No, it's you always go back 2, 3, 4 years in some cases, and you'll be able to use history to your benefit. So if there was business coming from it, it will be very difficult for you to prove it. If there isn't, then it will be very difficult for the IRS to prove the other way. So that was an interesting question. I really appreciate you answering that. And then there's another person asking another question. This one says, wait, so what if I take my client to both an entertainment event and the meal? So the entertainment event is deductible, but the meal is 50%. I would say no. It would have. They're both 50-50. So they both consider entertainment. They both consider entertainment.
I
And then
would say the same thing.
right. And then the follow-up question is, what if there's both entertainment and travel? So that's an interesting one because we're discussing the Super Bowl. So let's say you don't live where the Super Bowl is, and you take a plane, you go to the place where the Super Bowl is, with the sole purpose of meeting with your client, which travel there. That travel is technically part of the same entertainment. So the entire travel would be 50% deductible because this is
Correct.
the travel itself is not the business purpose, is the entertainment. So the entire package, because if you didn't conduct any business while traveling, the entire package will be deemed entertainment. So that's a very tricky one, by the way. I really appreciate you asking that. That's a really tricky one. And the other one, and Peter, I'll let you chime in on this, and this is a good one. What about alcohol? Does the IRS allow you to deduct alcohol as part of the meals and entertainment? What's your take on that? I don't think the IRS puts on the tax code, that libations are deductible or not. But do you have a specific take on this?
Yeah, I mean, I've never seen anything within the IRS code that speaks specifically about alcohol, because within the broader context of entertainment constitutes meals, dining, as well as adult beverages. So it's absolutely acceptable under the law, according to what I've seen and heard, and I've never seen that challenged.
Right. The only thing I will say, and obviously these are extreme circumstances. Let's say, for example, that you threw a big party, and everybody got drunk. Let's just call it that. Everybody got drunk, and then that same night you got a DUI. So there's public record that you were drunk, and you also deducted that party. Okay. I think the IRS can make a pretty strong case that because you were drunk, it's very difficult to conduct business. So I think because all these things are pretty much left to interpretation. This is, believe it or not, tax code is a lot more gray than black and white. So I would say, in California, for example, you have people have wine with their dinner, and it's normal. Okay, so I don't think alcohol is prohibited, but if it is absolutely obvious that all you had is an excess amount of alcohol and that's it, it is impossible to really conduct business, while intoxicated. So I think that if there's an extreme case, the IRS could disallow alcohol, unless you have a different take on that, Peter. But that's my take.
Well, we don't use this term often much anymore, but back in the days of Mad Men advertising, there was such a thing as a 3-martini lunch, of course, and all those 3 martinis were all deductible. So that's all I'm going to say about that.
That's a good one. Okay. All right. So let's talk about another context of meal, which is called, some people call it meals for employees or meals, quote unquote, for the convenience of the employer. Now, this is tricky. This is you buying meals for your employees, but not every day, because if you buy an employee meal every day, that's actually technically compensation. That's a whole nother issue. Could you buy coffee for the office? Could you buy donuts? Could you buy bagels? Yeah, that's not considered a meal. That's more of like a meal for the convenience of the employer. Or let's say, for example, you're working overtime and you order a pizza so people stay a little bit longer. Or let's say you're in the middle of tax season and you order lunch for everyone so they don't leave and they work while eating lunch. So the industry matters a lot. Industry matters a lot. In the construction business, it's very typical. I have a lot of clients in the construction business that ask their people to stay 2, 3, 4 hours more, and they literally goes to McDonald's and just buys them all hamburgers. Something that it doesn't spell business, right? Like you can't really conduct business over a McDonald's burger. Normally you wouldn't. But the context that you're doing it is you're buying the meal for the convenience of the employer because your employees are being worked extra and you don't want them to leave the work site and you want them to eat and work at the same time. So if you make the case for that, then that would be 100% deductible. And let's talk about the concept of business travel. So what constitutes business travel? So we're kind of coming full circle with this conversation. Number one, we want to make sure that our travel is business related, so it's 100% deductible. So what I do is that I don't work around my vacation. I vacation around my work. And let me tell you what I mean by that. Like I literally only vacation a few days before or a few days after a conference. So I go to 2 to 3 conferences in different parts of the country, in some cases international. And I try to make a vacation before and after. Why? Because not the entire trip wouldn't be deductible if you're mixing business and pleasure. But you basically take the whole total number of days that you're traveling. So let's say, for example, I'm traveling for 7 days. And the location that I'm traveling in, I'm conducting business for 5 days. So let's say I'm spending a whole week at my new client's office in Ireland, or I'm spending a whole week at a conference. And then I take the extra 2 days, Saturday and Sunday, for my own personal travel. So what's nice about that is I can take 5/7, right? So 5 divided by 7, 5/7 of the entire trip as a business trip. And then 2/7 of it would be a personal expense, right? So you can take a vast majority of your mixture, personal, leisure, and business travel by making sure that you are doing something around those days. So that's kind of like the case. So if you come in, do business, and come back, 100% deductible. If you come in, do business, stay a weekend, right, then you have to prorate it. Peter, you have any experience with that or any particular?
Yes, I mean, actually, I do have this, and I have seen it with some of our tax clients, which is that clients often here on the West Coast go to Hawaii for family trips and things. But what we've been able to do, and we've been able to support through the tax code, is if the primary purpose of the trip was for a business trip to meet a client, to tour properties there, or something along those lines, and if by calendar, if you can substantiate that the majority of the trip, in terms of the number of days that you spent actually conducting business or prospecting or working with clients, if the majority of the days was for a business purpose, then the travel over and back could be fully deductible. And then, of course, you'd have to prorate your expenses while you were on island.
Okay, so you're saying that if you spend more than 50% of the entire trip conducting business, the airplane ticket itself could be 100% deductible. But the 2 days of the hotel you were doing personal stuff, and the 2 days that you ate doing personal stuff, those wouldn't. Is that what you're saying?
That's what I'm saying.
Okay, yeah, that's perfect. Thank you. I appreciate that. That's a good take on that. All right, so we're gonna change gears a little bit and talk about vehicle and mileage. Now, golden rule: if you own a business, especially a C corporation, right? So again, if you own a business, especially a C corporation, you want to make sure that that vehicle is titled under the business. The insurance is commercial insurance, right? Remember, when you buy a car through a business, you don't get those 0.9, 1.9, 2.9% promo rates. Most of the time, that has to be a personal loan. So that's where people make a lot of mistake, where they'll buy a car under their personal name to get better deal on the financing, but it's titled under their personal name. So it's much difficult to make a business case that the vehicle is 100% for commercial use. The other thing they do is because personal insurance is typically cheaper, less expensive than commercial insurance, they also don't do the commercial insurance. So it's going to be very difficult for you to come to the IRS and say, hey, yeah, this vehicle is 100% business. Oh, but by the way, I'm personally on the hook for the loan because it's a personal loan. The title's under my name and it's personal, non-commercial insurance. So that's the concept, right? If you got a business vehicle, it needs to be owned by the business, especially with a C Corp. And if you do got a business vehicle, again, owned by the corporation, with the insurance is insured under the corporation pays for the loan because the loan is to the corporation's name, and there's no personal use, or at least more than fringe, right? Because fringe personal use is not a problem. Like for example, you have a business vehicle that's 100% for business, but on the way to the office, the person will stop in and pick up his laundry, for example, 5 miles every quarter. Don't worry about it. Okay, that's fine because that would be fringe. But if the employee uses the business vehicle to take a vacation and take a road trip, then that would not be fringe, right? Because that has an actual real cost. So that's the general concept. So if you have a business vehicle that is titled as a business vehicle and there's personal use, you're going to have to record how much of it is personal use. And if the person using it is an employee, that needs to be calculated as compensation. So you can reverse the mileage rule back to them. So if I have a business vehicle that the employee uses for 1,000 miles for personal use, then I'm going to take 1,000 miles times the mileage rate and include that in the employee's W-2 because that is indirect compensation. Now let's talk about the opposite side of the spectrum. Let's say, for example, I have an S Corp or a partnership, or I'm self-employed with a sole proprietorship, and the vehicle is owned by me personally. I own the title, I own the insurance, and then I'm using part of it for business. Now, if you use a personal vehicle for business, your substantiation, it's going to have to be much greater. You have to prove that whatever you're deducting from that personal vehicle, it's business use. And typically, the golden rule for that is called the mileage log. So you literally have a pen and paper and you say, day 1, I traveled 20 miles. Day 2, I traveled 30 miles. Day 3, I traveled 50 miles. And the mileage log, needs to contain the address where you're going to and what the business purpose was. So visit a client, whatever it happens to be. Now, nowadays, it's the year 2017. So nowadays, people use apps for that, right? They'll use the QuickBooks Self-Employed app to record their miles, or they use an app called Mile IQ to record their miles, or they use like a notepad, or they email it to themselves, whatever. So it doesn't have to be pen and paper, but there has to be an actual mileage log that contains the date, the miles, and the business purpose. A lot of times, most of my clients, what they do is they don't keep that. They don't keep a mileage log. And then we basically, because we don't have one, we have to make a judgment case for what percentage we're going to use. So I would say that the safest number to use, it's 50%. Always start with 50% and then move up and down the needle from there based on the industry. So for example, if I have a customer that's on the real estate business and they're showing houses every single day with the personal vehicle, I think I am comfortable with moving the needle from that 50% mark closer to 75% mark, closer to 80% mark. Now, I will never make a personal use vehicle 100% deductible if that person doesn't have an additional vehicle available for personal use. So, long story short, I have a business owner that's husband and wife. The wife mostly works from home or doesn't work or is a homemaker, whatever. And then the husband does everything through the business. Golden rule, I could probably make the case that one vehicle is 100% business use and another vehicle is 100% personal use because I have a secondary vehicle for personal use. But because I could make that case. But again, you could also have the business vehicle used for personal purposes. And if you can't make the case, then we'll revert back to the mileage log. Okay, show me the mileage log. And you would have to prove that whatever mileage is in the car now matches 100% of the mileage recorded on the mileage log. So that industry barometer is really, really important as well. Peter, do you want to say anything about that before I show the mileage reimbursement rates?
Yeah, so yeah, this is really getting into the weeds, definitely, because you have the context of a vehicle that you own yourself and you use within the context of a business, as opposed to a company-owned vehicle where the substantiation requirements are going to be much less, because the overarching premise is that if the vehicle is owned by the business, then it's going to be used primarily within the business purpose, whereas a vehicle that you own yourself, if it's the only vehicle that you own, then it's going to be very, very difficult for you to substantiate a large percentage of the use of that vehicle to be conducted within the trade or business. Now, if you work from home, let's say you're a sole proprietor and you work from home and you conduct your business within your home, and you have to go out to meet somebody, then of course all of those expenses, all of the mileage, or if you're going to use the direct expense method, all of those expenses would be deductible as long as you maintain the mileage log.
Right. And let me break down what you mean by the standard method, the direct expense method, or the mileage log, the mileage method.
Mm-hmm.
So the actual vehicle expenses are going to be, if you lease the vehicle, obviously the lease expense, the insurance, the gas, repairs and maintenance to the vehicle, right? Parking and tolls. Those are going to be what you call the direct expenses, right? Now, if you don't have good enough substantiation for direct expenses, or you prefer not to use a percentage of direct expenses, you can just use the mileage rate. So you basically have a mileage log and you multiply the miles times the IRS rate. So let me go to a different website real quick. I'm literally just going to Google IRS mileage rate, okay? And it should take you straight to the IRS website where the mileage rate is, and it will actually tell you what is the mileage rate for this year right here, 53.5 cents. So that basically means that I'm not going to deduct the gas, I'm not going to deduct the depreciation of the vehicle, I'm not going to deduct the lease payment, I'm not going to deduct the insurance, I'm not going to deduct repairs and maintenance for it. The exception could be parking and tolls, because parking and tolls are still indirectly associated with the vehicle expense. So if I decide not to use any of my real actual expenses, I can just take the 53.5 cent for that. This is for 2017 times the rate, and that will make that deductible. Why is that important? Because that's the same concept that you use when an employee uses their own personal vehicle to maybe deliver something for you or pick up something for you as a business owner, and you're going to reimburse them. That's how much the IRS allows you to reimburse and not have to include it in a W-2 or not have to make it compensation. Right? And so I talked about leasing versus owning. So when you lease the vehicle, the lease payment is the rental expense. That would be part of your actual expense. But if you own the vehicle, then the vehicle payment itself is not the expense, is the depreciation of it. And there will be the depreciation of it times the business use. So then it becomes a little bit hairy, which is, I prefer the mileage system, because if I have one of those free apps where I'm keeping my miles and I multiply times the miles, then I don't have to worry about substantiating anything else. Plus, then you run into the issue of lavish and extravagant. Is it necessary for me to have a vehicle so I can travel to my clients' offices if I do on-site work? Yeah, I would say yes, I need to have a vehicle. But is it necessary that I have a helicopter or a Ferrari, right? Or a Bentley, whatever, right? So is it necessary? Well, it's necessary to have a car, but I don't have to have such a lavish car to go visit my client to do their bookkeeping work. So this is where it becomes a little bit hairy when the vehicle is really, really expensive or is deemed as luxurious. So that's why you always fall back to the mileage rate, because no matter how expensive the vehicle is, how much of a gas guzzler, how much insurance is, the mileage rate is a consistent number based on the actual business miles. So again, you have to choose whether you're going to use the direct method, which is you're going to calculate everything, or you're going to use the actual mileage. All right, so let's do the last topic, Peter, which is a home office deduction. And do you want to maybe explain what the regular method is, and I'll explain the simplified method?
Sure, of course. Thank you. So there's been a recent change to the law here in the last few years. It used to be that there was only one way of deducting home office expenses, which was basically the method which required you to take the square footage of the property that you live in, your primary residence, and then identify which space within the home was used exclusively for the trade or business. It could be a separate room. It could be a desk in the corner of a family room. As long as that space was used exclusively for the trade or business, you would essentially map out the square footage of that space and then use that as the percentage against the overall square footage of the home to identify what the business use percentage of the property was. And then following on upon that, of course, you would then take the expenses associated with maintaining the home, mortgage interest, property taxes, maintenance, utilities, insurance, and so on, and then use that business use percentage to identify the quote-unquote cost, if you will, of that space that you had allocated for the home office, and that would then constitute the home office deduction on a Schedule C. That's a simplified explanation.
Exactly. And there's some key elements to this. One of it is called exclusively and regularly. So exclusively means that space is delineated for business use, and there's no personal stuff that can happen in that space, right? That's what exclusively means.
Careful.
Right? What do you mean?
Nothing. Go ahead.
Yeah, so I'm saying as long as there's no personal anything happening, any personal enjoyment of any sort in that geographic space, that would be exclusive use. Then you have regular use, which is a different concept. Regular use can't be like, well, one time during summer, I used the corner of my house to do, this type of project, and then all of a sudden I'm going to take the entire the entire year's worth of deduction. It doesn't work that way. It has to be regularly used. It has to be, for example, you wake up every morning, you take a shower, you brush your teeth, and you go straight to your computer in your desk every day. Check your business email. That's regularly. That's good enough. That's good enough. Now, it also needs to be separate, identifiable space from a geographic perspective. So literally, it can't be, well, I'm working on the wall. No, you don't work on the wall. You work on top of the floor. So exactly like he said, it has to be based on square footage. So you take the entire square footage of the house. It'll be good to have a blueprint or have some sort of record of the survey, but you have the entire square footage of the house and you figure out how much space you're taking. And most people have tile. So I basically go when my clients tell me, hey, how much space should I take? I look at the tile and I just count the tile. If it's 1 foot tile, I just do, that's 3 by 3. That's, whatever, right? So, or you can physically measure. Now, I recommend, I had a client that had a room, an entire room that was about 350 square feet dedicated for the office. I told them to take a picture. And I actually asked them to email it to me. Why did I ask him to email it to me? I didn't care about the picture. It's so they can have a record of the timestamp on when the office was built. Again, because if they move in 3 years and the IRS comes and they don't believe them, they can't go back in time and show them the room. So that's why I strongly recommend that you take a picture and have a blueprint to kind of substantiate that space, especially if it's going to be a big space, if it's going to be a big expenditure. Now, regular method. So we take the percentage of everything, our rent, electric, water, maintenance, depreciation of the house, interest expense, everything, phone, utilities, everything that makes the house basically work. You take a percentage of that, and that would be your regular method. Obviously, a lot harder to substantiate because you have to have records of the separate identifiable space. But the simplified method just made it really simple. IRS says if you got the square footage, just multiply it times $5, and that would be your entire deduction for the year. So if you got 300 square feet, and that's the limit, 300 square feet times $5, 1,500. You don't have to substantiate anything. You can take the entire interest expense. You don't have to take a portion of it out, and that's what made it really, really simple. Also, it's important to have a home office, especially for travel purposes. Why? Because if you don't have a home office and you work at your clients' sites all the time, technically the first client you go to becomes your home office, and you don't get to take the gas or the vehicle or the travel to the first location of the first house. So it's very important that you start at your home office and then travel. That way, the entire movement from your house to your first client becomes deductible. So, any color commentary there?
No,
Peter?
it's good. That's good.
So, Peter,
That's good. Thank you.
Thank you very much for joining us. This was super fun. Again, Peter's
Yeah.
email is.
Thank you.
You want to give him your email on your website, Peter?
Sure, yeah. Thank you, Hector, very much. Thank you for your time taking and staying with us all the way to the end. If you want to reach out to me, I'd be happy to connect with you and spend time with you. My email address is Peter C. That's my first name, Peter, last name, Cullen, C is first initial, Peter C at coreperformance.net.
Okay.
Thank you.
Thank you, Peter. Appreciate it. Back to work, back to doing taxes.
Okay. Thanks, guys.
And my email is hector@garciacpa.com if you want to connect with me. And just hang on for another minute. I just want to talk to you about all the other webinars that I'm involved with. You know, I'm very passionate about sharing what I know. So first of all, Tax Power Hour. This was the first one. We had over 50 people. I really appreciate the ones that stayed, the ones that asked questions. Hopefully we answered most of your questions. If not, of course, email us and we'll try to give you an answer on that. Monthly, every month, first Wednesday. So next month, we're going to have Chris Reagan here, who's a CPA, and he's an expert on entities. So we're going to talk about taxation on C Corps, S Corps, partnerships, LLCs, sole proprietorship. So we're going to kind of explain the difference between all of those. The month after, we're going to have Mariette, and she's an expert on independent contractors and self-employed. So we'll discuss in detail the difference between them and what are some of the nuances behind employees deducting quote-unquote business expenses versus independent contractors doing that. And then on May 3rd, we'll be having expenses versus fixed assets and depreciation, which is another big topic. And then we don't have every other topic scheduled out, but that's pretty much what it's going to look like. You don't have to do anything additional. Just wait for the email reminder, and that's it. Now, today, there's another webinar in exactly 1 hour. So I get to eat lunch and then do the next webinar called Excel Power Hour. And this is a monthly webinar series also starting today about Excel, and it's about Excel skills. So that will be exactly in an hour, 2 p.m. Eastern. We'll talk about cleaning up data before importing it to an accounting system or before generating or for generating pivot tables or reports. And tomorrow, there's a webinar that I'm involved with, but I'm not doing it tomorrow. My partner Michelle is doing it. And it's called QB Power Hour, and it's going to be about managing accounts payable in QuickBooks Online. So to register for that, go to qbpowerhour.com. And then in 2 weeks, we're going to have the Enterprise Expert Webinar Series webinar, which is all about QuickBooks Enterprise. This is more about enterprise, mid-market, mid-size business enterprise technology. So to go to that, just go to enterprise.expert. No need to put www, just enterprise.expert to do that. So again, thank you very much. Stay connected. Watch out for our website, taxpowerhour.com. Join the Facebook group. Just search Tax Power Hour. Continue the conversation. Ask questions. Be part of it. If you're interested on guest speaking or adding content or just kind of helping us grow Tax Power Hour, just email me at hector@garciacpa.com or hector@taxpowerhour.com. It all goes to the same email. Again, thank you very much, and hopefully I'll see you at Excel Power Hour in about an hour. Thank you.